Over the past year, I've had deep conversations with around 40 business owners, and many of them are going on acquisition journeys and buying competitors. And so I just wanted to jump on here and talk about what are the ways you can fund an acquisition and the levers that you can pull to execute a deal. When looking at an acquisition, there are three methods to fund the deal. The first is debt, the second is equity, and the third is seller consideration. Now, debt is a very powerful tool. And the more secure the debt is, the less expensive it is as you as the borrower to take it. And it's used by most private equity, which is a very good sign that used in the correct manner, it's a good tool. When looking at debt, you should think about it in two camps: asset-based lending and cash flow lending. Asset-based lending looks at receivables, machinery, inventory, or property, any physical asset that you can leverage against to take a loan. And when you hear about no money down deals or acquisitions on the internet right now, in the finance world, we call this a thin cap deal, i.e. putting the minimum amount of equity in as possible. You're probably financing it through an asset-based lend. The second is a cash flow lend. Cash flow is very different. So it looks at the profit and loss statement in a business. And it is usually a term loan. And what we mean by that is it's paid over a fixed amount of time. It could be 1 year, it could be 5 years long. And that's based off the free cash flow the business is generating. If it's making 1 million or 2 million pounds worth of profit, you may be able to secure a 3 million or 6 million pound facility. Now, one of the amazing features of cash flow lend, if you are able to achieve it, is a bullet repayment. And a bullet repayment looks at meaning that you don't have to pay the debt over the 5 years, but you can pay a significant amount of it at the end of the term. Why is that really powerful? Because it means that the business isn't under that strain to repay the debt over a monthly or quarterly period. And if the business grows over that period of time, then you have a more valuable business to refinance or sell to repay that debt at the end of the 5 years. Moving on to equity, and this is my favorite subject matter. Personal equity is required in almost all deals. That signals commitment to the lender, but also to the seller to say, I believe in this deal and I'm willing to put my money where my mouth is. But it's also usually the constraint of the deal. Many business owners think, what is the minimum amount of equity I can put in this deal myself? I like to reframe that, and we like to reframe that, McKeven Partners, to say, if equity was not a constraint, how would you fund that deal? And the reason why we do that is many business owners over leverage deals and take on too much risk because they are scared to put equity into a deal and protect the cash that they've worked very hard to accrue. Instead, think differently. How much cash do I have for the deal? What return on investment do I want from the deal? And what funding stack allows me to achieve this? Now, looking at the middle one, what return on investment do I want? Debt allows you to increase your return on investment because you're putting less of your own money in. If capital or if equity was not the constraint, what return on investment would we actually be satisfied with? And if equity was not a constraint externally as well, would we put more equity into the deal? And so if we go through that framework of thinking and equity is the answer, then let's think about how we raise equity. So the first is retail investors. Business owners have built a very big network of people that trust their judgment. If they built very successful businesses, they're probably a shrewd investor and operator. And so the layman or the unsophisticated investor may be very interested in executing a deal alongside them for favorable terms of the business owner. The second is institutional investors, family offices, high net worths, funds or independent sponsors. And that's where all our network of relationships come into play. We deal with all these individuals. They're incentivized to spend equity and do great deals with great business owners. Finally is seller consideration. And this is the most powerful and exciting tool that you can use to execute a deal. Seller consideration in simple terms means payments to a seller made after the deal is closed. It forms part of most deals and provides buyers the protection that the seller is going to show up the Monday after the deal is done to provide a sensible handover period and make sure that everything just doesn't fall over the day after the deal closes. There's two real powerful tools to use for seller consideration. The first is deferred consideration, or what the finance industry call DEFCON. And that is a defined payment plan that you pay the business owner regardless of the business performance. It's a debt. The second is an earnout, and that works in a very different manner. That is completely linked to performance and normally incentivize the seller to stay on and achieve certain targets after they've sold the business. For example, an earnout may be linked to profitability. And if the business owner increases profit by 10, 20, 30% over a period of time, they may receive a proportion of that profit. And that causes a win-win for both buyer and seller. The seller is receiving extra cash that they necessarily might not have thought they'd receive, and the buyer has increased profitability in their business and made it a more valuable company. And so when used correctly and motivations are aligned, you can achieve some great results after the transaction is closed. So those are the three areas you can use and components to fund a transaction, and you should use them in acquisitions you're trying to purchase. Hopefully some of the information has been useful, and if so, please do hit that subscribe button where I'll be producing more content like this to allow you to gain insight into the finance industry and execute acquisitions in the correct manner. Thank you.